You have heard of SIP, you have heard of lump sum, but there is a third way to invest, one that quietly beats both. It books profits automatically, cuts risk, and still compounds your wealth, even when the markets are sideways. Most investors have no clue that it exists. Let me show you how swing investing in mutual funds really work. This is not day trading. It is not timing the market. Instead of investing all your money on one date, split say 10 lakhs rupees into smaller equal chunks and invest them in a staggered date within a month. You can do it weekly, say every Monday. You invest different index mutual funds. Now when the fund price, that is the NAV, rises by about 5% above your purchase price, you book that profit. You don't wait endlessly for that perfect moment or the next bull run. You take the profits and you reinvest the capital in the next cycle. So how does it actually work? You first pick about say 15 to 20 mutual funds, only index funds with zero exit load, split them between Nifty, Sensex, mid cap, depending on your risk profile. Second step, divide your total amount. Suppose say it is 10 lakhs that you want to deploy. Instead of investing it all at once, you break it into smaller chunks and you spread them out across the month, say 4 phases every Monday or every Wednesday. For example, you could invest about 5% of the total amount each week, that is 50,000 per week. Over a month, you would roughly invest 2 lakhs, and by the end of 5 months, your entire 10 lakhs capital would be systematically deployed. Now comes the choice. Should you keep investing in the same index fund every week, or should you switch between a few of them? That's entirely up to you. The key is to pick up funds with zero exit load, low TER, and preferably old funds with higher AUM so that your tracking error stays low. You can either stick to 4 index funds or you can rotate through each of them every month, or you can pick different ones. Both approaches work. If you use different funds, it's easier to track when each fund hits 5% profit target limit. However, if you prefer using the same funds repeatedly, just make sure to keep proper records. That's because every new purchase changes your average purchase cost. So when the NAV rises by 5%, you will need to identify and sell only the earliest lot that hits the target, not your entire holding. The idea here is discipline, small staggered investments, regular profit booking, and clear tracking of each lot. That's what makes this swing strategy both systematic and also effective. Now there are more than 20 index funds that have zero exit load. And if you want me to give you a list of such index funds, please drop a comment, index funds, and I will share you a list. The third step is to set your target. Once your investment is in place, set a simple rule. When the NAV rises 5% above your average cost, sell the lot and book profit. Unlike SIP or lump sum, where you're investing and waiting for long-term compounding to do the heavy lifting, here we are measuring how quickly can the market deliver 5%. Track how many days each lot took to hit 5%, and then you can calculate the annualized return. Over time, repeat this process across multiple of these funds and market cycles, and you'll see a pattern. Some funds reach the target faster during a bull phase, some take longer during a bear phase. By tracking these intervals, that is how many days it takes to hit your target, you can calculate the annualized return of your portfolio, and you can understand the true performance, not just the nominal 5% target. This approach turns market volatility into opportunity. Instead of worrying about when the next rally will come, you are simply saying, whenever it comes, I will take my 5% profit and book it and move on. That's the real power of a swing strategy. You stop waiting for long-term rewards and you start letting short-term pay you, and that you do systematically. And what do you do with the money once you've booked the profit? You reinvest back into the next phase, your original capital, into the swing cycle, either the coming week or once you complete the full chain of 4 to 5 months of deployment. This keeps your money continuously in motion, compounding throughout the process with new opportunities instead of sitting on idle. That's the essence of swing strategy. You profit, reinvest, repeat. A disciplined cycle that keeps your capital productive. At the same time, you keep the emotions away. Fourth is, what if none of your investments hit the target 5%? Even after 5 months, none of your investment, let's say, hits your target. Don't panic. If that happens, simply start fresh round of staggered investment just like before. This will help you average your cost down and keep your portfolio aligned with market levels. So if the market stays flat, stay patient, you will average down and you will be ready when the next swing comes. You can track all this easily using a Google Sheet, and here it will automatically show you funds that cross 5% on a gain level. Now your important question is, what returns can you expect? Logically, it's going to align with the long-term market returns, which is in the range of say 12 or 12.5%. Based on a back test done by Fire in India, it showed about 10 to 12% annualized return, similar to the SIP. I'll provide the link to the back test in the description. You can take a look at it. It showed about 10 to 12% annualized return, similar to SIPs, but with lower emotional stress and drawdown, because here you are systematically booking the profits and you're taking it away. That way you're managing the risk and volatility. So why bother with swing investing if SIP can give you similar returns? That's a good question. If both can give around 10 to 12% returns, why complicate things? Well, it is not just about returns. It is about control. It's about emotion and liquidity. Let me show you how these things stack up. In the swing approach, it is not about chasing higher returns every time. It's about managing behavior and managing flexibility. SIP, you stay invested, but you watch your portfolio fall in a bear market. That's when most of the investors lose patience. But with swing investing, you stay active. You're booking small parts of the profit, redeploying the original capital, taking the profits away. You're mentally staying light. The other modes of investing have different advantages and different flip sides. So it is up to each individual. You know, there is an old idea that says sense is less than the mind, which is less than the intelligence. Every investor operates in these three dimensions, sometimes from the senses, sometimes he works from the mind, and sometimes the investor works from intelligence zone. When he works from the senses, he seeks instant gratification. That's where swing investing appeals. When he is working from the mind, he builds habits and a discipline like SIP investing. And when he is actually operating from the zone of intelligence, he understands cycles. He allocates across multiple assets. He focuses on wealth preservation and steady growth rather than very high return. About taxes, every income is taxed, whether it is salary or profits. So why expect anything else from here? Tax is not a penalty, it's a proof that your plan has actually worked. SIP builds wealth quietly while swing keeps you engaged as you build it. It balances your goal of a decent return with better risk management by not holding on too long during unfavorable periods and also averaging the purchase cost over time. In swing, you're booking profits regularly. Your SIP, you're letting it compound. Each suits different temperament. Some prefer activity, some prefer patience. And for those who are seeking periodic income rather than waiting for many years, this approach might fit in because the profits are booked, you're taking it off and you're spending it. That way, you are actually minimizing the volatility risk. And when someone says, but what about taxes on those swing profits? That is still the mind reacting. It is not the intelligent zone guiding because any income is taxable. Salary, rent, business, profit, dividends. Swing investing works because market swings. It swings between optimism and fear. It combines two simple truths. First, the market do not move in a straight line. They swing between fear and greed. Second, discipline beats prediction. So by automating the entry and exits, you are actually letting the numbers decide, not the emotions. You avoid buying too high or staying stuck too long. If you are considering this, stick to index funds, large cap or diversified funds. Check for zero exit loads, keep expenses low under 0.5%. If you are a low risk investor, and you do not want to take equity risk yet optimize return, watch my video about only switching the gains from a liquid fund to a small cap, keeping your original capital intact from any risk. You may also be interested in watching this video. If you found this content useful, please hit the like button, subscribe to this channel, and share it with someone who's still stuck without a strategy. Please let me know in the comment section your views about this and we can discuss it there.